Hello friends. So friends, we are going to continue with our topic of ratio analysis, right? And in the ratio analysis, we were discussing about solvency ratios. Solvency ratios tell us about the long-term position of business. Tell us about the long-term financial position of the business, right? So solvency ratios tell us about the long-term financial position of the business, and so far we have covered three solvency ratios. The first one was debt equity ratio, right? The second one was total assets to debt ratio, and the third one was proprietary ratio, right? So we have covered these three ratios under the solvency ratios, that is the debt equity ratio, total assets to debt ratio, and the proprietary ratio. Now in this lecture we are going to cover the fourth type of solvency ratio, fourth and the last one, that is interest coverage ratio. Now if we talk about the ratios, I told you in the very first lecture that ratio is a relationship between the two financial factors of the business. So we have to study the financial factors. So first of all, we will identify what are the two financial factors involved in the interest coverage ratio, right? From the name itself, you might not be able to understand what are the two aspects that we are going to cover in this interest coverage ratio. First of all, we will know what are the two aspects. Then we will try to establish a relationship between the two aspects which will lead to a ratio, right? So the two aspects that we are going to cover here is, the first one is profits before interest and tax, and the second aspect is interest on long-term debt. Clear? So first of all, what we have identified the two financial factors between which we will establish the relationship to identify the ratio. The first factor is profits before interest and tax, and the second factor is interest on long-term debt. Clear? So now we'll try to establish a relationship between these two financial factors. We'll take an example. Say there is Mr. X, right? And there is a bank A. Bank A Limited. Now Mr. X has taken a loan of say rupees 50 lakhs. Mr. X has taken a loan of rupees 50 lakhs from Bank A Limited, right? So Mr. X, on the repayment of this loan, Mr. X will have to pay two things. One is the principal amount, right, plus interest on loan. Obviously, if the bank is giving you a loan, the bank will charge something in return for using its money. So that amount is known as interest on loan. So Mr. X will have to pay the principal amount of 50 lakhs plus whatever the interest on that principal amount, isn't it? So now what is the relationship between the profits and interest? Right? This ratio is calculated to identify whether Mr. X is earning sufficient profits to pay this interest on loan. Whether Mr. X is earning sufficient profits to pay off this interest on loan. Right? So, interest coverage ratio interest coverage ratio is calculated to identify whether business is earning sufficient profits to pay off interest on long-term debts, right? So interest coverage ratio is calculated to identify whether business is earning sufficient profits to pay off interest on the long-term debts. Whether the profits are able to cover your interest cost on the long-term debts or not. Very simple. Clear? And for this purpose, what we are going to do is, see, when you calculate your profits, see, this is profits, right? Out of these profits, first of all, you will pay interest, right? This is what we call it as profits before tax. These are profits before interest and tax, right? Then whatever profits are left, on this you will pay tax to the government. These are the net profits that will come to your pocket, right? So these are the net profits that will come to your pocket. First you will earn the profits before interest and tax. On that you will subtract the interest, right? What you will get? Profits before taxation. And from that you will remove the taxation part, and what is left with you is the net profits. Clear? What is left with you is the net profits, but for the purpose of interest coverage ratio, we have to consider these profits before interest and tax, whether you have sufficient amount here to pay off this amount. If you don't have the sufficient amount here, then how will you pay interest? You will not be able to pay. Clear? So we have to consider profits before interest and tax. So what is the interest coverage ratio? Interest coverage ratio is profits before interest and tax divided by interest on long-term debt, because in the solvency ratios we always consider the long-term financial position of the business. Clear? Are you getting my point? So higher the ratio, higher the ratio, better it is. Right? Higher the ratio, better it is, because if the profits are high, the margin of safety is high for the lenders. That means the company will be able to pay interest on the borrowed funds. Clear? So friends, this is about the interest coverage ratio, where we try to build relationship between profits before interest and tax. Right? And we try to build a relationship between interest on the long-term loan. And I have explained you why we take the profits before interest and tax, because if you don't have the profits, sufficient profits at this stage, you will not be able to pay the interest. If you are not able to pay the interest, that means you will not get the profits here. That means no taxation. Right? So that's why we consider profits before interest and tax. This amount should be sufficient to pay off the interest on the long-term debt. Clear? Clear, friends? So this is about the interest coverage ratio. It is a very simple ratio. The only thing is you need to understand the logic. Clear? So friends, what we have covered is, so far, the first we covered liquidity ratios. Right? Liquidity ratios talk about the short-term position. Under the liquidity ratios, we studied two types of ratios. One is current ratio, and the other one is quick ratio. Right? Then we moved on to solvency ratios. Solvency ratios talk about the long-term position. Right? So, under the solvency ratios, we studied four ratios. Number one, debt equity ratio. Right? Then we studied total assets to debt ratio. Then we studied about proprietary ratio. Right? Then interest coverage ratio. See, in all the ratios, the first and the foremost thing that you should be very clear about is you have to identify the financial factors in every ratio. Whenever you start doing a ratio, first identify the financial factors between which you have to establish the relationship. Then you have to understand what is the relationship between those financial factors that you have identified. Right? If you are able to do these two things, then you are through with the ratio analysis. Right? First of all, identify the financial factors, then try to build the relationship between those financial factors. Clear? So friends, in the next lecture, we're going to start with the new type of ratios, that is activity, or I can say turnover ratios. Right? A little logical but interesting ratios. Right? So if you have any queries, just send me an email at ksjteaching@gmail.com. Clear? I'll try to answer all your queries as soon as possible, and in the next lecture we are going to start with activity ratios. So that's all for this lecture, friends. Thank you so much.